I have sat across the ticker tape for more years than most men in this business have been alive. I have watched fortunes rise and fall not because of bad luck, not because of rigged markets, not because the game was unfair, but because most traders never learn to read the one thing the market draws for them every single day: the line, the trend, the channel. The invisible road that price travels, that most men never see properly, and that when they do see it, they connect the wrong dots, draw the wrong lines, and wonder why the market humiliated them again. Let me tell you something that took me years and more losses than I care to remember to understand. A trend line drawn incorrectly is worse than no trend line at all, because a bad line gives you false confidence. And false confidence in this business is the kiss of death. Here is what the average trader does. He looks at a chart, finds 2 points, any 2 points where price touched or came close to some imaginary slope, draws his line, and calls it a trend line. Then he waits, and when price violates that line, he calls it a breakout. Then price reverses, and he calls it a fakeout. He is confused, he is frustrated, he loses money, and he blames the market. But the market did nothing wrong. He drew the wrong line. When I was operating in the great bull markets of the early 20th century, I did not connect any 2 points on a chart. I was not interested in random noise. I was interested in the story that price was telling me through its significant turning points, what I call pivotal points. These are the places where price made a decisive turn, where buyers overpowered sellers so completely that price reversed and moved meaningfully in the opposite direction, or where sellers crushed buyers so thoroughly that a top was put in, a top you could point to weeks or months later and say, that was the moment. Those are the only points worth connecting. Significant swing highs, significant swing lows, not every little wiggle, not every minor pause, the major turns, the moments where the market declared its intent. And I want you to think about what that means for your own trading. How many trend lines have you drawn on random touches? How many times have you connected a high from a Tuesday to a high from a Thursday on a 15-minute chart, called it a downtrend line, and built a whole trade around it? That is not a trend line. That is a straight line on a noisy chart. The market owes you nothing for drawing it. The next rule, and this is one most traders skip entirely, which is precisely why most traders fail, is confirmation. A proper trend line requires a minimum of 3 touches to be considered valid. 2 points define a line, yes, that is geometry. But 2 points do not define a trend. 2 points define a guess. 3 touches, 3 separate moments where price respected that line, turned from it, and continued in the established direction, that is confirmation. That is the market speaking to you directly. That is price telling you, this line matters. This level means something. Pay attention. Before we go any further, I want to take a moment and speak to those of you who are new here. We have covered a great deal of ground in our previous videos: pivotal points, position sizing, the psychology of waiting, and if you have not seen those, I encourage you to find them in this channel. Every lesson builds on the last. Every concept connects to the next. You are not just watching isolated videos. You are building a framework, a philosophy, and the more of these you absorb, the more clearly the market will begin to speak to you. Now, let us talk about time frames, because this is where I see traders make critical errors even when they understand the first 2 rules. They draw their trend lines on the wrong charts. Here is how I think about it. Major trends, the moves that define a market for months or years, must be identified on the weekly chart. That is your foundation. That is where you find the great highways of price, the dominant direction that governs everything below it. If the weekly chart shows a clear uptrend, higher highs, higher lows, and a trend line connecting those significant lows, then you have your bearings. You know which side of the market you want to be on. The daily chart reveals the minor trends, the intermediate waves within that major move. These are your opportunities. This is where you find the rhythm of the market, the pulses and pauses within the dominant direction. A minor pullback in a weekly uptrend, visible on the daily chart as a short-term downtrend line being broken, that is your entry signal forming. And the 4-hour chart, that is your precision instrument. That is where you fine-tune your entry, where you wait for the confirmation that separates the disciplined trader from the gambler. Top-down analysis, weekly to daily to 4-hour, major trend to minor trend to entry confirmation. This is not complex, but it requires patience. It requires the discipline to wait for all three time frames to align before committing a single dollar to the market. If you are enjoying what you are hearing, and I hope you are, do me one simple favor right now. Hit the like button below this video. Leave a comment. Tell me which part of this hit home for you. Share this with another trader you know who is struggling. These gestures cost you nothing, but they help this message reach the people who need it most. We are building something here together, and your engagement is what makes it possible. Now I want to speak about something that most traders treat as an afterthought, but which I consider one of the most powerful signals the market can produce: a broken trend line. When a valid trend line, properly drawn, properly confirmed, with 3 or more touches across the appropriate time frame, when that line breaks, something significant has happened. The market has shifted. The balance of power between buyers and sellers has changed in a meaningful way. This is not a small event. This is what I would call a pivotal point in the life of a trend. And like all pivotal points, it demands your full attention. Think about what a trend line represents. It is a record of the market's behavior over time. It is the slope of supply and demand in action. Every time price touched that line and bounced, the market was telling you that the dominant force, buyers in an uptrend, sellers in a downtrend, was still in control. 3 touches, 4 touches, 5 touches, each one reinforced the message. Each one strengthened the line. And then the line breaks. When price closes convincingly beyond a valid trend line, not a mere tick, not a slight overshoot that immediately reverses, but a genuine, decisive, close on the other side, that is, the market, announcing a change of character. The old order has been disrupted. The traders who were comfortable on one side of the market must now reconsider their position. The traders on the other side now have the wind at their backs. For me, a broken trend line was never just a signal to exit. It was a signal to think, what does this break tell me? Is the major trend reversing, or is this a correction within the dominant direction? The answer depends on which trend line broke and on which time frame. A broken trend line on the 4-hour chart, within the context of a strong weekly uptrend, may simply mean the minor pullback is ending and the larger move is about to resume. That is a buying opportunity. But a broken trend line on the weekly chart, one that had been intact for months, confirmed by multiple touches, that is a completely different conversation. That is the market telling you that something fundamental has changed, and you had better listen. This is why the multi-time frame approach I described in the first section is not optional. It is not a preference. It is the framework that allows you to interpret what a trend line break actually means. Without context, a break is just a break. With context, a break becomes actionable intelligence. Now let me bring you to the concept of channels, because this is where the discussion of trend lines becomes truly powerful for those who understand it, and where those who do not understand it continue to lose money in ways they never quite figure out. A channel is formed when price moves between 2 parallel trend lines, one connecting the significant highs, one connecting the significant lows. In a rising channel, you have a rising support line along the lows and a rising resistance line along the highs. In a falling channel, the same structure exists but tilted downward. And in a horizontal channel, what most traders call a range, you have flat support and flat resistance, with price oscillating between them. The strategy within a channel is elegant in its simplicity. You buy the lower channel line, you sell the upper channel line. Or, in a downward channel, you sell the upper line and cover at the lower. The market, for periods of time, moves with remarkable predictability between these boundaries, and the trader who understands this can extract gains from a market that appears to be going nowhere. But let me give you the deeper wisdom here, because channels are not just about buying support and selling resistance. They are about understanding the nature of the trend hidden within the channel. A ranging market is not a dead market. It is a market that is accumulating or distributing building energy for the next significant move. The professional operators, the large interests, they use these ranging periods to quietly build or reduce positions. The retail trader sees a boring sideways market and either walks away or trades it recklessly. The disciplined trader, the one who has studied Livermore's principles, watches the channel carefully. He watches how price behaves near the boundaries. Is it getting weaker at the upper boundary? Are the rallies becoming shorter? Is price failing to reach the upper line anymore? These are signs of distribution. The big money is selling into every rally. The smart money is unloading, and the uninformed public is eagerly buying at the top of the range. Conversely, is price bouncing more sharply off the lower boundary? Are the dips becoming shallower? Is there urgency on the upside and weakness on the downside? That is accumulation. Someone is buying everything the panicked sellers throw at them. This is the art of reading channels, not just mechanically buying support and selling resistance, but understanding the language that price speaks within the boundaries. And speaking of language, I want to remind you about two resources that we have made available to you. The first is our ebook, Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. Everything I am speaking about in these videos, the philosophy, the principles, the framework, it is laid out systematically in that book, not as a collection of trading rules, but as a way of thinking, a way of approaching the market that separates the professionals from the amateurs. You will find the link in the video description below. The second resource is the Livermore Journal, a 90-day trading psychology workbook, because knowledge without application is worthless. The journal is designed to take what you learn here, in the books, through your own experience and ingrain it through daily practice. 90 days of structured reflection, of tracking your decisions, your emotions, your discipline. The link for that is also in the description. I urge you to get both. They work together, just as these videos work together. I want to bring this all together now, because there is a lesson underneath everything I have shared with you today, a truth that goes beyond trend lines, beyond channels, beyond time frames and confirmation rules. A truth that every trader who has ever sat where you are sitting has eventually had to confront. The market does not reward cleverness, it rewards discipline. There is no shortage of clever traders. The markets are full of intelligent people with sophisticated systems, with algorithms and indicators and elaborate theories about price behavior. And most of them lose money consistently. Not because they are wrong about the analysis, but because they cannot wait, they cannot hold, they cannot execute their own rules when the market puts pressure on them. I learned this lesson in a brutal classroom. I watched men who were smarter than me, with better information than I had, with more capital and more connections, lose everything, not once, multiple times. And in every case, it was not the market that destroyed them, it was themselves, their impatience, their ego, their inability to sit still when sitting still was exactly what the situation demanded. Let me bring this back to trend lines and channels, and close this lesson with something practical that you can carry with you forever. When you draw a trend line, you are not predicting the future. You are recording the past behavior of price and using it to identify the most likely path of least resistance going forward. That distinction matters enormously. Prediction implies certainty. Reading the tape implies probability. The market always has the final word. Your job is to be positioned correctly when it speaks and to manage your risk intelligently when it speaks against you. Here is the complete picture. On your weekly chart, you identify the dominant trend. You connect the significant swing lows in an uptrend, those decisive turning points, the pivotal points, and you draw your major trend line, 3 touches minimum before you trust it. You know from that weekly chart which side of the market the big money is on. Then you drop to the daily chart. You look at the minor trend within that major move. You look for the channels that price has formed along the way, the rhythmic rising channels of a healthy uptrend, or the corrective falling channels that offer you entry opportunities when they break to the upside. A falling channel within a weekly uptrend is not a signal to sell short. It is a signal to wait patiently, quietly for the break back upward, for the moment when the minor trend line breaks and price resumes its dominant direction. That break, confirmed on the 4-hour chart, is your entry signal. That is the precision point. And when the major weekly trend line breaks, genuinely breaks, with conviction, with a decisive close beyond it, you do not argue with the market. You do not insist that you are right and the market is wrong. That is how men lose everything. You accept the message, you manage your position, and you wait for the new order to reveal itself. Because after every broken trend, a new trend begins. After every channel exhaustion, a new pattern emerges. The market is never finished. The game is never over. I have one more thing I want to say, and I want you to hear it clearly, because it is perhaps the most important thing I have ever said to anyone about this business. Most traders spend their entire careers looking for the perfect entry, the precise moment, the exact indicator combination that will never fail. They hop from strategy to strategy, from book to book, from video to video, always searching, never arriving, and I understand that impulse. I felt it myself in my early years. The desire for certainty in an uncertain game. But the traders who made real money, lasting money, the kind that changes a family's fortune, were not the traders who found the perfect system. They were the traders who mastered themselves, who waited for the right conditions and then acted decisively, who were wrong sometimes and admitted it quickly and cheaply, who were right sometimes and let those trades run until the market told them it was over. They were the traders who treated each lesson as an investment, not a cost, who studied their failures with as much rigor as their successes, who built systems and then had the discipline to follow them even when their emotions screamed otherwise. That is what we are building here together, not a collection of techniques, a philosophy, a way of seeing the market and yourself within it. So here is what I ask of you today, not just for my sake, but for yours. Like this video if it has moved something in you. Leave a comment, tell me where you are in your trading journey, what you are struggling with, what has clicked for you today. Share this video with someone you know who is losing money in the markets and cannot figure out why. Your share might be the thing that changes their trajectory. And when you are ready to go deeper, when you are ready to take this philosophy from your screen into your soul, the links are waiting for you below. Thinking like Jesse Livermore. Mastering the market with discipline, patience, and risk. And the Livermore Journal, a 9-0 day trading psychology workbook. Both of them in the video description. Both of them designed for the trader who is serious, not the trader who dabbles, the trader who is committed to becoming something different than what they are today. I have traded through panics and booms, through wars and recessions, through markets that seemed to defy all logic and markets that moved with textbook precision. And if I could send one message back through time to every trader who ever lost more than they should have, who ever broke their own rules when the pressure got high enough, it would be this. The line is drawn for you. The market shows you the trend. The channel shows you the range. The pivotal point shows you the change. All you have to do is see clearly, wait patiently, and act with discipline.